Hey everyone, welcome to another deep dive with us. Today we're going to be looking at hedge funds.
Ooh, hedge funds.
Yes. Yeah, they can seem kind of like a black box. Right.
Definitely mysterious, a little bit intimidating even.
Exactly like this exclusive club for, the financial wizards.
Yeah.
But I think understanding them can teach us a lot about how markets really work.
I totally agree with that.
So we're going to be taking a deep dive today with The Little Book of Hedge Funds by Anthony Scaramucci.
Okay, the mooch.
Yeah, the mooch. So before we jump into the book, I think it's helpful to know a little bit about Scaramucci himself. He's not just an academic who write about finance.
Not at all. He's got serious Wall Street cred. He founded Skybridge Capital, which is this global investment firm, and he's managed billions of dollars in assets.
Yeah, and he even had that very brief stint in the White House as the White House communications director.
Right. A very colorful character, to say the least.
Definitely.
Yeah.
But I think, all those experiences mean that he's seen this world from a lot of different angles. As a manager, as an investor, as someone who's been in the public eye.
Yeah, absolutely. And I think that really comes through in the book.
Totally. So, one of the first things I always think about with hedge funds is like, what exactly is a hedge fund?
Yeah.
It's always seemed kind of vague to me.
It's tricky to define precisely. There's not like one universally agreed upon definition.
Right.
And actually, Scaramucci dives into that right at the beginning of the book. He looks at all these different definitions from experts and kind of pulls out those common threads, those key characteristics that they share.
So what are some of those characteristics? Like what makes a hedge fund different from, say, a mutual fund?
Okay, so one of the big differences is the goal that hedge funds are all about pursuing what's called absolute returns.
Absolute returns.
Yeah. So that means they're trying to make money no matter what the market's doing.
So up, down, sideways.
Exactly.
Okay. That sounds pretty appealing.
Right. Especially in a volatile market.
Yeah, for sure. But how do they actually do that? What makes them so different?
Well, one thing is they tend to use a much wider range of investment strategies and asset classes than you would see in a traditional mutual fund.
Okay, so we're not just talking about stocks and bonds here.
Not necessarily. They might invest in real estate, commodities, derivatives, all sorts of things that you wouldn't typically find in a mutual fund portfolio.
Oh, okay. So that's where that term hedge comes in.
Exactly. They're trying to hedge their bets, diversify their investments to protect themselves against losses in one area,
Right.
but potentially gaining in another.
Makes sense. But I've also heard that hedge funds are kind of only for the super rich.
Yeah, there's definitely some truth to that. They're typically only open to what are called accredited investors.
Accredited investor.
Yeah, which means people who meet certain income or net worth requirements.
So there's definitely an exclusivity factor there.
For sure. And another key difference is the fee structure. Hedge funds are notorious for charging what's called 2 and 20.
2 and 20. I've heard that. What does that mean?
So it's a 2% annual management fee plus 20% of any profits they generate.
2 and 20. Wow. That's a lot.
It is. But that high fee structure is part of why they attract top talent and aim for those really outsized returns.
Right. So it creates a high stakes, high reward environment.
Exactly. And actually, Scaramucci tells this great story in the book about a friend of his who transitioned from managing mutual funds to running a hedge fund.
Oh, really? I'm curious to hear what happened there.
Well, apparently the friend was attracted to the potential for lower volatility and higher returns compared to mutual funds. It's a good anecdote that kind of sums up that core appeal of hedge funds for both managers and investors.
So they're selling themselves as this way to kind of weather any market storm and come out ahead.
Yeah, that's the idea. And that leads us to a question that a lot of people have. How do hedge funds actually do that?
Yeah.
How do they achieve those uncorrelated returns? Returns that aren't necessarily moving in the same direction as the overall market.
Yeah, that's the million-dollar question.
Right. I'm guessing it has something to do with those strategies and the alternative assets that they're using.
Exactly. And Scaramucci actually talks about one of the tools that hedge funds often use called leverage. Leverage. Okay. Now, I feel like that's a word that gets thrown around a lot in finance,
It does.
but I'm not sure I totally understand it.
So think of it this way. Imagine you're playing poker. You've got a certain amount of chips in front of you, right? That's your own money.
Right.
Leverage is like being able to borrow chips from the casino to make bigger bets.
Oh, so you can amplify your potential winnings.
Yes, but also your potential losses.
Ah, okay, so it was a double-edged sword.
Exactly. It's a tool that can magnify both gains and losses. And it's something that hedge funds can use much more aggressively than, say, a mutual fund.
So that's one way they can try to generate those outsized returns.
Exactly. But it definitely comes with increased risk.
For sure. So I feel like to really understand how hedge funds work, we need to look at their history a little bit.
I agree.
Where did they come from?
Yeah, how did they evolve?
Yeah, how did they evolve into these major players in finance?
Right. And Scaramucci actually takes us on this really interesting historical journey in the book. He starts way back in ancient Greece.
Ancient Greece, really?
Yeah. He talks about this philosopher named Thales, who essentially came up with the first hedge.
Wow.
He predicted a bumper crop of olives and then cornered the market on olive presses, which basically guaranteed him a profit no matter what happened with the olive harvest.
So the idea of hedging has been around for centuries.
It has. And then Scaramucci brings us into the 20th century and introduces Alfred Winslow Jones, who's considered the father of the modern hedge fund.
Okay, what did he do?
Well, he pioneered the strategy called long-short equity, which we'll talk about more later.
Okay, so we've got the ancient Greeks and the birth of the modern hedge fund. What comes next?
Well, then Scaramucci takes us through the rise of some of these legendary hedge fund figures like George Soros, Julian Robertson.
Big names.
Huge names. They made billions with their bold bets and really shaped the industry.
Right? I think everyone's heard of George Soros.
Of course. Famous for breaking the Bank of England.
Exactly. But Scaramucci doesn't just focus on the successes, right?
No, he also talks about some of the big failures.
Oh, yeah, I love those stories.
Yeah, those cautionary tales.
Yeah.
He has a whole section on the collapse of long-term capital management, or LTCM.
LTCM, okay.
This hedge fund that was run by a team of brilliant minds, Nobel laureates even.
Wow, so what went wrong?
Well, they took on massive amounts of leverage and made these really complex bets that just totally backfired when the Russian financial crisis hit in 1998.
Oof.
Yeah, they lost billions in a matter of weeks.
It's a reminder that the bigger they are, the harder they fall, I guess.
Absolutely. It highlights the risks involved, especially when leverage is in the mix.
For sure. So I'm curious, you're talking about the history of these funds. We're also talking about how they've evolved. And in the next part, I really want to get into how they've evolved from these exclusive clubs for the ultra-wealthy to attracting capital from endowments, pension funds, all these institutions.
Yeah, it's a huge shift. It's changed the landscape of the industry for sure.
Definitely. But before we get into that, I want to take a quick pause and turn it over to you. What are you thinking so far?
What's grabbing your attention about this world of hedge funds?
We'll be right back after a quick break. We'll be right back after a quick break. Okay, so we're back, and we were talking about this shift. You know, how hedge funds went from being this exclusive club for the super rich to attracting investments from these big institutions.
Yeah, it's a huge change. And to understand how that happened, we got to go back to the early 90s.
Okay, back to the 90s.
And this guy named David Swensen.
David Swensen.
Yeah, he was the chief investment officer for Yale University's endowment.
Yale.
Yep. And he's considered one of the first to really see the potential of hedge funds for these institutional investors.
So before Swensen, these institutions weren't really paying attention to hedge funds?
Not really. They were mostly focused on, traditional investments like stocks and bonds.
Got it. So what made Swensen decide to change things up?
Well, he was looking for ways to diversify Yale's portfolio, beyond just those traditional assets.
Makes sense.
And he believed that hedge funds, with their unique strategies and their potential for uncorrelated returns, they could really help boost the endowment's performance.
So he saw something that other institutions were missing.
Exactly. Iedi was ahead of the curve, and under his leadership, Yale's endowment generated some really impressive returns.
And then everyone else started paying attention.
Exactly. Success breeds imitation.
Right. If it works for Yale, it must work for everyone.
That was the thinking. And that influx of institutional capital really changed the game. Hedge funds became much bigger and more influential.
Wow. So it's amazing how one person's vision can have such a big ripple effect.
It really is. But let's get back to the strategies themselves.
Mm-hmm.
We touched on this concept of alpha earlier.
Yeah.
And I think it's worth digging a little deeper because it can be a bit of a head scratcher.
It is a little confusing.
Yeah.
So remind me again, what exactly is alpha?
Okay, so alpha is essentially a measure of a manager's skill in generating returns that are independent of the overall market.
Okay, independent of the market.
Right. So if the market goes up 10% and a hedge fund manager also goes up 10%, that doesn't mean they've achieved alpha.
So they're just riding the market wave.
Exactly. Alpha is about generating returns that go above and beyond what the market's doing.
So it's like they're not just passengers on the roller coaster, they're somehow controlling it.
I like that analogy. And that's what really separates those truly skilled hedge fund managers from the ones who are just kind of, riding the market's coattails.
Okay, that makes more sense.
Right.
But is alpha even real? I mean, can you really consistently beat the market?
Well, that's a question that's been debated for a long time. There's this theory in finance called the efficient market hypothesis,
Okay.
which basically says that all publicly available information is already reflected in stock prices.
So according to that, it should be impossible to consistently outperform the market.
Right. But even the people who believe in the efficient market hypothesis acknowledge that there can be short-term inefficiencies.
Like little cracks in the system.
Exactly. And that's where hedge fund managers come in. They're constantly looking for those little cracks, those opportunities to exploit.
Interesting. So it's less about predicting the future and more about finding those inefficiencies.
Right. And Scaramucci argues that true alpha is rare, but it can be found. He points to specific managers and strategies that have consistently outperformed the market over long periods.
So it's like the holy grail of investing.
Kind of. It's what everyone's chasing.
Yeah.
And in the book, he actually outlines 4 main categories of hedge fund strategies that managers use to try to generate alpha.
Okay, 4 main categories. I'm ready to hear what they are.
All right, so we've got long-short equity, relative value, event-driven, and directional.
Okay, let's break those down. What's long-short equity?
So that's the classic hedge fund strategy that Alfred Winslow Jones pioneered. Remember him?
Yeah, father of the modern hedge fund.
Exactly. So long-short equity involves taking both long and short positions in stocks.
Hold on, long and short positions. Can you explain that in a way that I can understand?
Sure. Imagine you think Apple stock is going to go up. You would take a long position, meaning you buy the stock hoping to sell it later at a higher price.
Okay, that makes sense.
Yeah.
What's a short position?
A short position is when you think a stock's going to go down. You're essentially borrowing shares of the stock, selling them at the current price, and hoping to buy them back later at a lower price to return to the lender.
Ah, so you're profiting from the decline.
Exactly. And that allows hedge fund managers to potentially make money in both bull and bear markets.
Interesting. So it's all about finding those companies you think are going to outperform or underperform.
Exactly. Scaramucci uses this great analogy. He calls it borrowing from Peter to pay Paul.
I like that. Okay, so that's long-short equity. What about relative value?
Relative value strategies are all about trying to exploit price discrepancies between related securities. It's kind of like arbitrage, buy low in one market and sell high in another.
So finding those little inefficiencies where things are mispriced.
Exactly. And these strategies can get really complex, involving things like options and futures.
Okay, starting to get a headache just thinking about it.
Yeah, they can definitely be complicated, but the basic idea is to find those pricing discrepancies and capitalize on them.
Got it. What about event-driven strategies?
The event-driven strategies try to capitalize on specific events like mergers, acquisitions, or even bankruptcies.
So they're betting on how these events will impact a company's stock price.
Right. It requires a lot of research and analysis to try to anticipate how those events will play out.
So like a financial detective.
Exactly. And then you have directional strategies, which are basically bets on the overall direction of a market.
So like betting that the stock market as a whole will go up or down.
Exactly. These strategies often involve looking at macroeconomics, analyzing things like interest rates, inflation, and economic growth.
Okay, so 4 main categories of hedge fund strategies. It sounds like there's a lot of variety.
There is. And each one requires its own specific skill set and expertise.
For sure. So Scaramucci also talks about another area that's closely related to hedge funds. Private equity.
Yes. Private equity.
That's another one of those terms that I hear a lot, but I'm not always sure I fully understand.
So private equity involves investing in companies that are not publicly traded on the stock market.
Okay, so instead of buying shares on the exchange, they're buying whole companies or stakes in companies that are privately held.
Exactly. And the goal is typically to buy a company, restructure it to make it more profitable, and then eventually sell it for a profit.
Okay, so it's a much longer-term investment.
It is. It can take years to realize a return, but the potential returns can be huge.
I've also heard that private equity can be a bit controversial.
Yeah, it has that reputation.
That vulture capitalism image.
Right. They've been criticized sometimes for loading up companies with debt-cutting jobs and, just focusing on short-term profits.
So it's not all rosy.
No, not always. But Scaramucci presents a balanced view. He acknowledges the controversies while also pointing out some of the potential benefits of private equity.
Like what?
Well, like bringing capital and expertise to struggling businesses. And he uses the example of Dell computers.
Dell.
Yeah. They went private in a leveraged buyout in 2013, underwent restructuring, and then went public again in 2018.
Wow, so public to private and back to public again.
Exactly. It just goes to show how private equity can play a role in the evolution of companies, and also how the lines between hedge funds and private equity can get a little blurry sometimes.
Okay, so I'm starting to get a better feel for how these different parts of the alternative investment world all fit together.
It's a complex landscape for sure.
It is, but it's fascinating stuff. What about you? What are your thoughts so far?
It's really making me think about, if I were actually considering investing in a hedge fund, what would I need to know?
Right, like what are the practical considerations?
Exactly. And that's actually what we're going to dive into next.
Perfect. Let's take a quick break, and we'll be right back to explore the practical side of hedge fund investing. Okay, so we're back and ready to get into the practical stuff.
Huh?
If someone's actually thinking about investing in a hedge fund, where do they even begin?
Well, Scaramucci spends a good chunk of the book talking about manager selection. And he really emphasizes that this is probably the most important decision you'll make.
That makes sense. It's not like you can just pick a hedge fund out of a hat.
Right. You got to do your homework. And he actually lays out 4 key things to look at when you're evaluating a manager: pedigree, opportunity, set, alpha, proposition, and structure. He even compares it to checking out a chef's credentials. You don't just wander into any kitchen hoping for a Michelin star meal.
I like that analogy. Okay, so break it down for me. What's pedigree?
So pedigree is all about experience, track record, and temperament. You want a manager who's been around the block, has a history of success, and also has the emotional stability to handle, the inevitable ups and downs of the market.
So it's not just about smarts. It's also about having the right personality to handle the pressure.
Exactly. Hedge funds are high stakes. You need someone who can stay cool under pressure.
Okay, what about opportunity set? What does that mean?
Opportunity set is all about whether there are actually market inefficiencies for the manager to exploit. Scaramucci says you can't squeeze blood from a stone, meaning even a brilliant manager can't generate alpha if there are no opportunities.
So you're saying it's not just about finding a brilliant manager. It's about finding a brilliant manager who's operating in the right environment.
Exactly. The conditions have to be right for their strategy.
Yeah.
And then you've got the alpha proposition.
Alpha proposition. Remind me what alpha is all about.
Right. So alpha, remember, is that measure of a manager's skill in generating returns that are independent of the market.
Okay, I got it.
The alpha proposition is about understanding what makes this manager special.
So what's their edge? What sets them apart?
Exactly. Do they have a unique model, a network, access to data, or some other advantage that gives them an edge?
That's like their investing superpower.
Yeah, exactly. And then lastly, there's structure.
Okay, structure. Tell me more.
Structure is about all the nitty-gritty details of the fund. The fees, the terms, the transparency, and whether the manager's incentives are aligned with yours.
Right, so you're not getting ripped off, basically.
Yeah, and that they're not taking unnecessary risks just to line their own pockets. Transparency is key here. You want to understand how the fund works, how they calculate fees and measure performance.
Okay, so we've got pedigree, opportunity, set, alpha proposition, and structure. 4 key things to consider when you're evaluating a hedge fund manager. But what about the average investor? Are hedge funds even an option for people who don't have millions to invest?
Well, traditionally, hedge funds have been pretty exclusive, but there's this thing called a fund of funds.
Fund of funds, I've
Yeah.
heard that term.
Mhm.
What is it exactly?
It's basically a fund that invests in other hedge funds.
Yeah.
So it's like a diversified portfolio of hedge funds managed by a team of professionals.
So it's a way to get exposure to multiple hedge funds without having to invest millions directly in each one.
Exactly. And it can give smaller investors access to those top managers.
Interesting. So Scaramucci also talks about something that I think a lot of people are curious about, a career in hedge funds.
Yeah, the dream job for many.
Right. It seems like it has this image of being super glamorous.
The big bucks, the fast-paced environment, the intellectual challenge. But Scaramucci doesn't sugarcoat it. He's honest about the downsides, too.
So it's not all champagne and caviar.
Not exactly. He talks about the long hours, the constant pressure to perform, the need to always be learning and adapting.
I can imagine. But for people who thrive in that environment, it must be exciting.
Oh, absolutely. And he offers some great advice for anyone interested in this career path.
What kind of advice?
Well, he talks about the importance of networking, building relationships, and really demonstrating a deep understanding of the industry.
So it's not enough to just have a fancy degree.
Nope. You need a strong work ethic, a passion for markets, and that willingness to always be learning.
Sounds like a tough but rewarding field.
Definitely. So I think we've covered a lot of ground today.
We have. We've gone from ancient Greek olive presses to the rise of hedge funds to manager selection and even career advice.
And Scaramucci's book is a great guide for anyone who wants to understand this world.
Totally. He really does a great job of making it accessible and engaging.
One of the big takeaways for me is that while hedge funds can be really profitable, they're not a magic bullet.
Right. They're not a get-rich-quick scheme.
Exactly. They involve risk, require careful research, and are really best suited for sophisticated investors.
That's a good point. As with any investment, do your homework, understand your risk tolerance, and talk to a professional before making any decisions.
Absolutely. And I think Scaramucci leaves us with this great thought. The world of hedge funds is constantly evolving.
So we need to stay curious and keep learning.
Exactly. There are always new strategies, new technologies, and the competition is fierce.
Well, I'm definitely feeling inspired to learn more. A huge thank you to you for walking us through this fascinating world.
It's been my pleasure.
Thanks for joining us on The Deep Dive. Until next time, keep exploring.